Ask almost anyone what Tesla does, and they will give you the same answer without hesitating for even a second. Tesla makes cars. Electric cars. Fast ones. Expensive ones. The ones that park themselves and update overnight like a smartphone. That is the story most people have locked in their heads, and honestly, it is hard to blame them. The cars are stunning. The supercharger network is everywhere. The Model Y was the best-selling vehicle on the entire planet in 2023. So when someone says Tesla, you think cars. You probably always have. But here is the problem with that assumption. The fastest-growing business inside Tesla right now has almost nothing to do with cars. And the business that is quietly generating the highest profit margins inside that company, the one that Wall Street analysts keep mentioning almost as a footnote, is not the one sitting in your driveway or in your neighbor's garage. It is not Autopilot. It is not the Cybertruck. It is not even the robotaxi that Elon Musk has been promising for years. The business that is actually pulling Tesla's financial results upward, while the car division stumbles, is one that most people have never even thought about. And once you see the numbers, you cannot unsee them. So let us slow down and do this properly, because this is not a story about a battery product. This is a story about what Tesla is actually becoming, and why the market, the media, and most investors may be looking at the wrong part of the company entirely. To understand why the assumption breaks down, you have to look at what happened to Tesla in 2025. The automotive segment, the cars, the deliveries, the thing that everyone watches, declined 10% in revenue year over year. 10%. In the same period, Tesla's total revenue fell 3%. The stock narrative was painful. Headlines focused on demand concerns, competition from BYD, price cuts eating into margins. And then, buried inside the earnings report, almost like an afterthought, was a different set of numbers. Tesla's energy generation and storage segment grew 27% in the same year. 27% growth while cars were shrinking. And the gross margin on that energy business was not 17% like automotive. It was 31%, nearly double. Think about what that means in practical terms. For every $100 of energy storage revenue Tesla collects, roughly $31 flows through as gross profit. For every $100 of car revenue, roughly $17 does. The energy business is not just growing faster. It is fundamentally more profitable per dollar of revenue. And yet almost nobody is leading with that story. The conversation remains obsessively focused on delivery numbers, on whether Elon said something controversial, on whether the Model 3 refresh looks different enough. Meanwhile, a completely different business is expanding in the background, and it is starting to matter enormously to the actual financial health of the company. Here is the number that should make you stop and read it twice. In 2025, Tesla's energy storage segment represented 13% of total revenue. 13%. But it generated 23% of Tesla's total gross profit. 13% of the revenue. 23% of the profit. That kind of asymmetry is the signature of a high-margin, high-growth business that has not yet been priced or discussed proportionally to its actual impact. The closest parallel most people would recognize is what Amazon Web Services did to Amazon for years. AWS was a small slice of Amazon's total revenue while simultaneously being responsible for the vast majority of the company's operating income. Tesla Energy is starting to follow a structurally similar pattern, and almost nobody in the mainstream conversation is treating it that way. So what exactly is Tesla Energy? Because when most people hear it, they imagine a solar panel on a roof or maybe a wall-mounted battery in a garage. And those products exist. The Powerwall is real. More than 1 million units have been installed globally. Those homeowners saved more than $1 billion in electricity bills in 2025 alone, which is genuinely impressive for a consumer product. But the Powerwall is not where the serious money is moving. The real engine of Tesla's energy business is called the Megapack, and it is a completely different category of product built for a completely different customer. A single Megapack unit is roughly the size of a shipping container. It stores enough energy to power approximately 3,600 homes for a full hour. Utilities buy them. Industrial operators buy them. Data center operators are increasingly buying them. These are not consumer purchases. These are infrastructure decisions, the kind that get made in boardrooms with 10-year planning horizons and contracts worth hundreds of millions of dollars. And in 2025, Tesla deployed a record 46.6 7 gigawatt hours of energy storage. That is 48 to 49% more than the year before. A 49% increase in deployments in a single year, while the car business was going backward. To manufacture that volume, Tesla runs 2 dedicated Megapack factories. One is in Lathrop, California, with an annual production capacity of 40 gigawatt hours. The second is in Shanghai, China, also rated at 40 gigawatt hours. Together, they represent over 80 gigawatt hours of annual manufacturing capacity. But demand is growing faster than those 2 factories can currently satisfy, which is exactly why Tesla is building a 3rd factory in Houston, Texas. The Houston facility will produce a next-generation product called Megapack 3, along with a new product called Megablock. That factory is expected to add 50 gigawatt hours of capacity and begin ramping in late 2026. When it reaches full production, Tesla's total Megapack manufacturing capacity will approach 130 gigawatt hours annually. That is not a niche operation. That is serious industrial scale. Now you might be asking yourself, why is this happening right now? Why is energy storage suddenly exploding? Why are utilities and data center operators racing to buy giant batteries as fast as Tesla can build them? And this is where the story gets much larger than Tesla itself. The answer, in 2 words, is artificial intelligence. The AI infrastructure build-out happening right now across the United States and globally is creating an electricity demand crisis that most people do not fully appreciate yet. Training large language models, running inference at scale, operating the server farms that power everything from search engines to medical diagnostics to financial modeling. All of it requires enormous, continuous quantities of electricity. By 2026, data centers globally could consume 1,050 terawatt-hours of electricity annually. To put that into perspective, that would make the global data center industry the 5th largest energy consumer on the planet, sitting between Japan and Russia in terms of total electricity demand. This is not a forecast from a fringe analyst. This is a mainstream projection, and it is already driving investment decisions at every level of the energy industry. Tesla's own AI computing cluster tells the same story from the inside. That cluster currently operates at 130 megawatts of power draw. By 2026, Tesla expects it to reach 500 megawatts. At peak demand, it already requires 250 megawatts, which is roughly the equivalent of the power consumption of 250,000 American households running simultaneously. One company, one AI cluster, the electricity appetite of 250,000 homes. And that is just Tesla. Multiply that pattern across Microsoft, Google, Amazon, Meta, and dozens of other companies all building competing AI infrastructure, and you begin to understand why grid operators in parts of the United States are already issuing warnings about their capacity to serve peak demand without cutting power to some facilities. Grid-scale batteries like the Megapack exist precisely to solve this problem. They store electricity when demand is low and prices are cheap, then discharge it when demand spikes and grid stability is threatened. They allow utilities to defer expensive infrastructure upgrades. They allow data center operators to guarantee power continuity even when the regional grid is stressed. And they allow renewable energy, solar and wind, to become more economically viable by solving the intermittency problem, storing the energy generated when the sun is shining or the wind is blowing and releasing it when neither is happening but demand is still high. The United States set a new record for electricity consumption in 2025, reaching 4,179 billion kilowatt hours. In 2026, the country is projected to set another record, reaching 4,239 billion kilowatt hours. The grid is being pushed harder than it ever has been, and the infrastructure was not designed for this. Energy storage is not optional in this environment. It is structural. It is the missing piece that makes the rest of the modern grid function properly. Against that backdrop, here is a financial detail that almost no one in the mainstream media has highlighted. At the end of 2025, Tesla was sitting on $4.96 billion in deferred revenue specifically related to its energy storage business. Deferred revenue means customers have already paid, contracts have already been signed, and Tesla simply has not yet delivered and recognized the revenue on its books. That $4.96 billion is expected to be recognized in 2026. That is double the deferred energy revenue from 2025. It is not a forecast. It is not a projection. It is money that has already been collected, sitting on the balance sheet, waiting to flow into the income statement. For a business that many analysts still treat as secondary to the car division, that is an extraordinary amount of contracted, forward visibility. Now, here is the part of the story where intellectual honesty requires acknowledging what is working against Tesla Energy, because there are real and serious challenges here, and dismissing them would turn this into promotional content rather than an actual investigation of what is happening. Competition is intensifying significantly. For 2 years, Tesla held the position of the world's largest energy storage system integrator by market share. In 2025, BYD overtook them. BYD now holds 13% of the global energy storage integrator market. Tesla holds 10%. Sungrow is third at 9%. And behind all of them, CAT, the Chinese battery giant, remains the dominant supplier of battery cells globally and is increasingly moving into system integration as well. These are not weak competitors. BYD has the manufacturing scale, the cost structure, and the domestic Chinese market advantages to sustain serious price pressure. Fluence, which is backed by Siemens and AES, is a credible competitor in the utility-scale market. The idea that Tesla will simply run away with the energy storage market without a serious fight is not supported by the evidence. There are also policy risks worth understanding clearly. The residential energy tax credits that helped make Powerwall adoption economically attractive for homeowners have been phased out under recent legislation. Commercial and utility-scale credits currently remain in place through the mid-2030s, which protects the Megapack business for now, but the regulatory environment is not static. Tariffs on battery cells are also increasing the cost of components, and while Tesla's vertical integration provides some protection, it does not eliminate the exposure entirely. The Megapack average selling price declined in 2025 even as volumes grew, which signals that pricing pressure is already arriving and is likely to intensify as more competitors reach production scale. The Houston factory is also not yet producing. It is expected to begin ramping in late 2026, and any significant delay in that ramp would create a gap between what demand is pulling and what Tesla can actually supply. Execution risk on major factory projects is real, and Tesla has experienced delays on large capital projects before. So where does all of this leave us? Here is the honest summary of what the data actually shows, without the hype and without the dismissiveness that tends to characterize coverage of this story from both directions. Tesla remains, by revenue, primarily an automotive company. Cars generated $69.5 billion in revenue in 2025. Energy generated $12.8 billion. Cars are 73% of total revenue. Nobody is arguing that energy has already surpassed automotive. That is not the claim here. The claim is more precise than that, and more interesting. Energy is growing at 27% while automotive is declining 10%. Energy has gross margins of 31% while automotive sits at 17%. Energy generates 23% of total gross profit while representing 13% of revenue. Energy storage deployments grew at a 168% compound annual growth rate over the past 3 years. The global battery energy storage market is projected to grow at 36.7% annually through 2030, compared to 21.5% for the electric vehicle market. And Elon Musk himself said in 2019 that the energy business would eventually be the same size as, or larger than, the automotive business. He said in 2022 that stationary energy storage was growing 150 to 200% per year, much faster than cars by a lot. And in 2024, he said the storage business is doing exactly what he predicted it would do. The question worth sitting with is this: if the energy storage market continues growing at its current rate, if AI infrastructure demand continues driving grid pressure, and if automotive growth remains constrained by competition and market saturation, at what point does the financial center of gravity inside Tesla actually shift? Not today. Not in 2026. But at what point through this decade does the conversation become Tesla is an energy company that also happens to make cars, rather than the reverse? Here is the thing about narratives in business. they tend to lag reality by years. Amazon was described as a bookstore that was losing money for most of its first decade, even while it was quietly building the cloud infrastructure that would eventually generate the majority of its profit. The narrative caught up to reality eventually. It usually does. And when it does, the people who were paying attention to the underlying numbers rather than the surface story tend to have been positioned much better for what came next. Tesla deployed 46.7 gigawatt hours of energy storage in 2025, enough to power roughly 168 million homes for a single hour. Its energy business generated nearly $4 billion in gross profit in the same year. It has almost $5 billion in contracted deferred revenue already on the books for 2026. And the single largest driver of energy demand growth, artificial intelligence infrastructure, is not slowing down. If anything, the projections keep getting revised upward. The company most people still think of as the one that makes the fast electric cars may be quietly building something much larger. The most important transformation happening inside Tesla right now may not be taking place on the road at all. If you want to stay ahead of what is actually happening in the industries that are reshaping the economy, not just the headlines but the underlying mechanics of where the money and the power are actually moving, hit subscribe. This is exactly the kind of story we are going to keep following.